But generally speaking, I think the cycle extends. I think crypto, I know you don't believe me, that's fine. I've been doing this since 2013. Will play catch up. I think the rotation of leads, so the darlings that you hold won't be the darlings that persist. So just be careful if you're an overly racy sector. The 90s were full of rotations.
For the past several weeks, crypto investors have had to endure relentless volatility. Every rally has been met with another wave of selling. Bitcoin has repeatedly tested critical support levels, and many altcoins have suffered even steeper losses. Fear has returned to the market, leveraged traders have been flushed out, and social media is once again filled with predictions that the bull market is over. Yet beneath all of this price action, some of the world's most respected macro investors believe the bigger picture hasn't changed at all. Recent market turbulence has been driven largely by a combination of stronger dollar dynamics, shifting rate expectations, and another broad deleveraging across risk assets rather than a collapse in crypto's long-term fundamentals. One of those investors is Raoul Pal. Having successfully navigated multiple market cycles over the past 3 decades, Pal continues to argue that investors are focusing far too much on short-term price swings, while ignoring the one variable he believes has consistently driven both Bitcoin and technology stocks for years: liquidity. According to him, crypto isn't broken, it is simply moving through another frustrating phase of the cycle, where capital rotates, weak hands are shaken out, and investors begin questioning whether the trend is still intact. History, however, suggests that these periods often create the biggest opportunities for patient investors willing to focus on the macro picture instead of daily headlines. In today's video, we'll break down why Raoul Pal believes this cycle may be far from over, why global liquidity remains the single most important indicator to watch, why he expects leadership inside crypto to rotate rather than disappear, and why today's painful volatility could eventually look very different in hindsight. But before we dive in, if you enjoy fact-based macro analysis and expert insights into Bitcoin, crypto, and the global economy, make sure you hit the like button, subscribe to the channel, and turn on post notifications so you never miss our latest updates. When crypto crashes, people panic. When the stock market dips, people sell. But gold? Gold has held value for 5,000 years, and it's not slowing down. Most people don't know you can hold physical gold and silver inside a tax-advantaged IRA. With iTrustCapital, you can. Buy and sell gold and silver 24/7. No dealer markups, no waiting on phone calls, no outdated processes. Just a few clicks, same as buying Bitcoin. And here's what makes it powerful. Pair gold with crypto in the same account. One hedge, one growth play, one platform. Your metals are held with institutional-grade custody and full tax reporting. Gains inside a Roth IRA, tax-free. Real U.S. customer support. $100 bonus when you fund through the link below. Markets change. Gold doesn't care. Now, let's hear what Raoul Pal has to say.
So global liquidity is going up. Recently, it's gone down a bit, but you get this cyclicality in liquidity that happens seasonally and stuff like that. So there's nothing to see here except liquidity rising. As you can see, it bottomed in 2022. This is when we went long the NASDAQ, and crypto and have been long ever since. So I know other people have joined at different points, but this is where we got long because of liquidity, and it's been rising ever since, and the markets have gone with it. Year on year, global liquidity, nothing to see. You know, you get these changes. This change are all the US dollar. So the US dollar strengthening right now. Finally, rates are coming down. They will come down a lot sharper. Again, I don't have time to go through all of this right now, but I will do on Real Vision again soon. So rates come down sharper. Also in Macro Investing Tool in Real Vision Alpha, we go through this in excruciating detail every single week. But the dollar's too strong. That's what's causing this. We've got the Venezuela and probably Iran sort of onboarding back into dollars. So that keeps a dollar bid, but rates are starting to fall, oil starting to fall. I think that all changes. But liquidity leads Bitcoin. Now it keeps moving and shifting. And there's somebody on Real Vision, Sarah Walker, who's been a fantastic part of our community, even though she bugs the shit out of me, which I joke with her about, but holds us accountable over things like, over the long run, global liquidity is the best predictor of asset prices. It's been the highest correlation to Bitcoin, about 85% to 87%. and for the Nasdaq, it's about 97.5. But she rightly pointed out that it shifts and correlations shift and different parts of the liquidity curve shift to Bitcoin. This is where I am right now, is total global liquidity seems to be roughly in line with Bitcoin right now. So that seems to be the dollar effect. And we'll talk a bit more about this in a sec. Nasdaq has been perfection. We called this sort of panic area and said, look, this is disconnected. It's stupid. It's gone back. It trades perfectly. Going back to my US liquidity, which I think is the big daddy of this cycle. Sometimes it had been China. And again, these are shifting variables. And I think it's important to understand that things shift and there's no perfection. US liquidity broad year on year is growing at about 3.5%, which is okay. It's not great. And we'll come on a little bit into that in a sec. Narrow liquidity is, that's it outright. It's moving up again. That was the TGA, the government shutdown. It's kind of recovering from that. Year on year, not great. So narrow liquidity, what is that? That is Fed net liquidity plus bank securities holdings. So this of Treasury holdings. So this is the the Treasury selling debt and the banks taking it on, plus the normal kind of central bank balance sheet, etc. And they're just starting to pick up, but they've been held back by a number of issues, and one of them is the flat yield curve. Again, a story for another day, but this is what's going on here. M2 is accelerating again. US liquidity leads the NASDAQ 100, so US seems to be the dominant factor right now. Again, it changed over time. Most of this is not a science, and it's all Bayesian. So I know in the past, everyone's got caught in the trap of like, well, the chart says this, and therefore that's going to happen. You can't do that. You have to just say, contextually, this is right. We need to watch for changes, all of that stuff. I was never clear enough in explaining that to people. I mean, I've been doing this 35 years. I just assume people understood that, but they don't. Here's narrow liquidity versus Bitcoin. Bitcoin's not, again, still not doing great. We've got these kind of liquidations going on right now, but comfortably over the short term. Here's the banks held. This is like, are the banks just monetizing the central bank balance sheet? That's growing at about 6 month, 5.4%, yearly, 3.8. So it's not massive yet, right?
Raoul Pal begins by revisiting the foundation of his entire investment framework. Long before many investors became bullish on Bitcoin or the Nasdaq, he believed expanding global liquidity would eventually push capital towards scarce, high-growth assets. Looking back, he argues that this relationship has remained remarkably consistent despite temporary deviations. While recent dollar strength, seasonal liquidity fluctuations, and short-term macro uncertainty have created another difficult environment for crypto, Pal believes these forces are just part of the normal ebb and flow of financial markets. In his view, liquidity doesn't move in a perfectly straight line. It rises, pauses, retraces, and then continues higher as broader monetary conditions evolve. That is why he places far more importance on long-term liquidity trends than daily price movements. He also cautions investors against treating any single chart or indicator as an absolute prediction of the future. Markets constantly evolve. At different times, global liquidity, U.S. liquidity, the dollar, treasury issuance, central bank balance sheets, or even China's credit cycle may become the dominant force. The objective isn't finding a perfect indicator, it is recognizing which variables matter most at a given moment. Although Bitcoin has struggled through another wave of liquidations amid today's volatile market, Pal believes the broader liquidity backdrop still supports the longer-term thesis. Even if price temporarily disconnects from fundamentals, that perspective becomes even more important as he transitions into explaining why he believes crypto's next major advance may be fueled by a very different type of liquidity than investors have been watching over the past year.
So we don't have massive monetary printing. And this is where you get into excess liquidity. Excess liquidity is the amount of liquidity growth in excess of GDP growth. Now, both measures are now positive, but they weren't. And that negative period was a negative period for crypto, because if there's no excess liquidity, it'll find its home in the most compounding place, and the place that compounds intelligence the most is AI. So it compounded there. But now we've got excess liquidity. It means there's more liquidity for investments. And this helps us. This happens with the business cycle too. As the business cycle gets positive, we get more earnings. And you can see that we had this is M2 version, which is not as good, but it gives you a long-term history. Is like, I think we're in the 1950s phase where excess liquidity was high at all points. I think we'll do that again. It was also high in the late 90s into the boom, and we're starting to go positive here. Productivity, which is the main part of that formula, is not yet positive versus inflation. So of that formula, inflation is still eating productivity. But what Kevin Walsh has talked about and Scott Besson has talked about is that switches. So there's a whole bunch of stuff there. But generally speaking, I think the cycle extends. I think crypto, I know you don't believe me. That's fine. I've been doing this since 2013. Will play catch up. I think the rotation of leads, so the darlings that you hold won't be the darlings that persist. So just be careful if you're an overly racy sector. The 90s were full of rotations. And have a plan. Have a plan about when you accumulate, when you exit. Why I didn't take lifestyle chips off the table. People are like, you didn't take lifestyle chips. Is because the indicator didn't give me lifestyle chips to take off. So I don't take them off. So then I end up adding. And I've been adding in crypto. And I've added recently, I've added several points around this kind of 1.5 standard deviation oversold level. And I'm comfortable with that because I've done the work. And I think that the crypto trend continues over time. And I've also had tech investments. But again, I'm starting to rotate and look at the different areas of tech. So, okay, hopefully that adds some value. I know it's, for those of you in crypto, it's like, it's fucking frustrating. You probably hate me. You hate everybody. And then there's the confusion amongst time horizons. You know, one person's got one time horizon, other person cares about the cycle. One person says the cycle's dead. I think it's a mid-cycle. So it's all fucking noise. It's all just fucking noise. You just have to focus on what is the big game? What is going to unfuck your future? Unfucking your future is compounding. Fucking up your future is trying to trade.
According to Raoul Pal, the most important shift now taking place isn't simply that liquidity continues growing, it's that the economy may be entering a period of excess liquidity once again. In simple terms, excess liquidity refers to monetary growth that exceeds the pace of economic growth. During periods when that happens, investors typically have more capital available to deploy into higher risk, higher return assets. Pal argues that crypto struggled while excess liquidity remained negative because capital naturally flowed toward the fastest compounding opportunity available at the time, artificial intelligence. But as monetary conditions gradually improve and productivity begins catching up, he believes crypto could once again become one of the primary beneficiaries of expanding global capital. That doesn't mean every cryptocurrency will automatically outperform. One of Pal's strongest warnings is that many investors become emotionally attached to yesterday's winners. Previous market leaders rarely remain the leaders forever. Just as the technology boom of the 1990s experienced repeated sector rotations before reaching its ultimate peak, Pal expects crypto to undergo similar leadership changes throughout the remainder of this cycle. Some projects that dominated the previous rally may underperform, while entirely different sectors could emerge as the market's next leaders. For investors, that makes flexibility just as important as conviction. Perhaps Pal's biggest lesson, however, has very little to do with charts or macroeconomics. It is about discipline. During periods like today's, when headlines grow increasingly bearish and volatility shakes investor confidence, many participants abandon carefully constructed strategies in favor of emotional trading. Pal argues that successful investing requires exactly the opposite approach. Have a plan before the market becomes emotional. Know why you're accumulating, understand what conditions would invalidate your thesis, and determine in advance how and when you'll eventually take profits. Those decisions become far more difficult when fear dominates every headline. Whether Raoul Pal ultimately proves correct or not, his central message remains remarkably consistent: focus on the long-term trend rather than the daily noise. Today's crypto market remains under pressure, with Bitcoin recently trading below the psychologically important $60,000 level after another wave of liquidations and continued macro uncertainty. Even so, many analysts view the recent sell-off as a severe correction within a broader cycle, rather than definitive evidence that the long-term trend has ended. For Pal, the variable that matters most is still liquidity, and until that trend changes materially, he believes the larger cycle remains alive. What do you think? Is Raoul Pal right that crypto is simply moving through another mid-cycle shakeout before the next major advance, or do you believe this volatility signals something much more serious? Let us know your thoughts in the comments below. If you enjoyed this breakdown, don't forget to leave a like, subscribe to the channel, and turn on post notifications so you never miss our latest Bitcoin, crypto, and macro market analysis. Thanks for watching, and we'll see you in the next video.